The U.S. government shutdown is finally over, and what does that mean for not only the equity markets, but also the economy? It's Tuesday, November the 18th, and this is Markets with Megan. If you like this podcast, please subscribe. You can hit the alarm bell. Also, always share it with any friends, family, or colleagues that you think might be interested on these regular market updates when it comes to the economy, economic data. What does it mean for your investment portfolios? Let's dig right in today to our topic, which is the government has finally ended the longest shutdown in history. And what does that mean now as we go forward? Well, first of all, let's just look back at history. There's been 4 other government shutdowns that have been nowhere near where we were in the recent shutdown, but more than 15 days. We tried to look at something that was the closest in length. And let's look at those 4 that were more than 15 days in length. What we saw for the dollar, for example, is that the dollar typically does decline on average about 1%, but it goes on to rise more than that, almost 2%, when the government does reopen. When you look at the S&P 500, that doesn't really seem to get too much of a movement when it comes to the dysfunction out of DC. You actually see the S&P on average rise about 1%. It does go back to rise about 4%, though, when the government does reopen. Now let's look at the recent shutdown. The S&P was up about 2%. So maybe we were borrowing a little bit of returns from the aftermath of the government reopening. From an economic perspective, it's a very mixed picture and not a clear one because typically shutdowns don't last a full economic quarter. So what we did see is, though, any pullback in personal spending or personal consumption that occurs during the shutdown tends to give it back when the government reopens. And that may have a little bit to do with the fact that government workers are not paid during the shutdown, but then paid that back pay when the economy does reopen. What we expect now, the markets are going to focus on when and what economic data are we going to receive. We are set to get the September jobs report this Thursday, the 20th. So markets will be focused on that. But then what does it mean for the Federal Reserve? The Fed has a meeting in December. Coming into the shutdown, the expectation for a rate cut were about 100% of a probability. That's fallen all the way down to 40%. And that's because of the private data that we've seen during this shutdown has been mixed. You've had a labor market that's weakening, but not really collapsing. And then you have some pressure on inflation. So this may cause the Fed to actually stay on hold. We actually think the Fed probably should stay on hold, barring any major collapse in the data we get this week, because there is time. They've done enough at this point. They can wait 1 month and assess the economic data. There's going to be a while that we're catching up. And as I mentioned, we don't know exactly what and if all of the economic data that we will see that was supposed to take place during that shutdown. That's all we have. If you have any questions or you want a further history of our podcast, you can go to marketswithmegan.fm. Thank you.